Our next panel is going to be moderated by the illustrious Huang, who also gave our keynote. He is going to be speaking with a rockstar panel about the implications of not only stablecoins, but also central bank digital currencies, CBDCs, on global monetary policy. I, for one, am very curious to see which governments are going to fight stablecoins and which of them are going to adopt them. And are CBDCs actual stablecoins, or what do we consider them? In fact, in India, there's obviously been a lot of headway made with the e-rupee. Anyways, without further ado, I would like to welcome back to the stage Huang and the panel. All right, please come to stage.
All right, thank you so much, everybody. Thank you for having us. I will do the intros. I'll start with Austin. Austin is founder of ZeroKnowledge Consulting and a professor at Columbia Business School. Austin is one of the world's most experienced architects of stablecoin reserves and backend. He is the main reserves architect behind Paxos USDP and BUSD stablecoins, and the main reserves architect behind PayPal's PYUSD stablecoin. Having previously worked at Citi and JP Morgan, Austin is uniquely positioned to bridge gaps between crypto and TradFi. Sam is one of the premier builders in DeFi and the founder of Frax protocol. Frax launched its stablecoin back in 2020, and it's grown to become one of the largest stablecoins. They also develop and operate one of Ethereum's largest liquid staking tokens, Frax Ether. Stefan is a serial entrepreneur and was previously CEO of Bitcoin.com. He's the founder of Nuon Flatcoin and Truflation, which is an independent inflation index, an alternative to the CPI. And finally, ADCV co-founded Steakhouse Financial, a boutique consulting firm that advises some of the major DeFi DAOs in crypto, such as MakerDAO, Sky, and Lido. ADCV is a deep thinker and a prolific writer on stablecoins, money, and decentralization. All right, first question, the stable innovation's core. What's the core stablecoin innovation that's earned it such a solid product market fit? Austin, you mentioned that interbank transfers require the sending bank to unwind its underlying investments and send over data and value. Then the receiving bank, again, invests that value in some underlying. It's slow and expensive. Stablecoins are much faster and cheaper because it's like everyone banks with the same single bank, the stablecoin issuer. So it's just an intra-bank transfer on the decentralized ledger. But everyone is not actually banking with the stablecoin issuer because not everyone can redeem fiat dollars directly with, for example, Tether or Circle. You'd have to be KYC'd with them. And I think it's not easy to directly KYC with them nowadays. So what if we elaborate to say that the stablecoin innovation is that we've split ownership of a payment account into two separate rights. One, the right to claim some underlying value, and two, the right to redeem that value directly from the issuer. So with centralized stablecoins, you have to simultaneously have both rights to redeem from the issuer. You need the token and the KYC status. So a stablecoin is like a transferable check. It holds value and can be transferred around, but only those with KYC status can actually deposit that check into the issuing bank and redeem it. Splitting an account into two rights and tokenizing the claim to the underlying has allowed cheaper, faster, and atomic transactions. The underlying reserve asset stays at the same bank, but we tokenize their claims and transfer the tokens on the public ledger. Secondary market liquidity has compensated for the lack of direct redemption rights with the issuer. People convert stablecoins back to fiat currency. Secondary liquidity sources such as exchanges, payment apps, on-ramps, or just P2P amongst themselves. Austin, Is this a core innovation of stablecoins that's made them so much better than TradFi vehicles? And what are some other core advantages of the stablecoin innovation?
Yeah, I mean, in some ways, I don't think it's so much different than traditional finance as we think about the market structure, right? So like, take the example of a stablecoin issuer. If you're Circle and you only allow a subset of people to onboard with you and mint and burn directly, you also have partners who allow many, many people to onboard directly with them, mint and burn with them because they just pass it through. So in that case, that could be, say, Coinbase, right? So if I have a Coinbase account, I can get between US dollars, USDC, USDC, US dollars very quickly. What I've just described, if I say slightly different names, is if I have a JP Morgan, so Chase, bank account, I could deposit and withdraw from that quickly in banking terms, so much slower than the stablecoin, and they're going to go face the Federal Reserve, right? Like I, Austin Campbell, don't have a master account with the Federal Reserve. And so I don't know that that structure is much different. I think what's different about it is kind of what you were hitting on before with the transferability of the thing. So in bank account world, sending money around is a closed, relatively archaic system that is not easily like visible to people. It batch settles. A lot of places don't have very good real-time payments, and if they do, they only have them domestically. Nobody has a very good 24/7 real-time payment system internationally other than blockchains. So that is actually, to me, the core innovation is you can get much higher velocity, and although you don't explicitly need KYC to make transfers at each step, public blockchains leak a lot of information. So like anybody here, this is not financial advice and it's not legal advice, but if you're committing crime, don't use a blockchain. They are very transparent. You will eventually get caught. And so I think it inverts the understanding of KYC, right? In the usual system, we say you have to clear the boundary and then you can kind of do whatever you want. Here we say there's no boundary, everybody is coming in, but we're going to watch your activity potentially much more closely. And I think that's very misunderstood. And so it creates a system where instead of all of these like balkanized, very regional hubs, both within the system and across like leaps in the system, especially when you go between nation states, you have a much more open access system where money can move with much higher velocity and efficiency.
Yeah. All right, Sam. Thank you, Austin. Sam, what's the core innovation of decentralized stablecoins versus centralized ones?
Yeah, so I'm not as qualified or knowledgeable about the traditional banking system as Austin. I'm not a professor, so I'm just a developer, mechanism design person. So I like to think of things very simply in terms of I see two types of stablecoins. One is the classical ones that can be redeemed for cash with this underlying piping, and two, decentralized stablecoins, of which Frax is one of the largest. And the main difference that I like to categorize Frax and decentralized stablecoins is it's actually more similar to the Federal Reserve in that I don't like to actually think of many different types of decentralized stablecoins, algorithmic, over-collateralized, this and that. I just have these two categories, stablecoins that have a bank account and that they're redeemable for underlying cash, and decentralized stablecoins that use smart contracts to stabilize a digital token's price to a peg, right? And so if you think about it, right now if you have $1, you can't go to the issuer, the Federal Reserve, you can't literally go there and ask them to redeem a dollar of gold or value or something on their balance sheet. You used to be able to do that, right? In the early 20th century, you used to literally, that's why it was called the discount window or the redemption window. That's literally where the name comes from. You could line up in the morning, you could take your dollar, and you could actually get back gold, as people know, right? And now you cannot do that. Banks cannot do that. And the Federal Reserve and the US government does not say that the US dollar is redeemable for anything underlying, not $1 worth of US treasuries, not gold, not anything. And I think this is a really important nuance, which is why I have these two categories of stablecoins in my mind, which is redeemable ones with the traditional piping, redeemable for cash or however banks settle, and then decentralized ones that work closer to the way that the actual central bank works. This is why my one pitch, one line definition of Frax is it's a decentralized central bank, because the structural economics of it, and it's hopefully very valuable and bullish for people if they think of it like that. And the real reason, though, is that the dollar, and the way that I think about it, is it has a peg, right? It's CPI plus 2%, 2.5%, which is the Fed mandate. And the only guarantee that the US government gives for the US dollar is that they will try to stabilize the USD's peg, so to speak, to this value, right? It is not redeemable. They do not give you a right of redemption, that you don't have any legal right to get anything from the issuer. Same thing with decentralized stablecoins. Frax does not have a bank account. It is not an entity. It exists only on decentralized networks, and now our own L2 Fraxtal blockchain. But it exists on many different places on decentralized networks. It is not a corporation. It is not an LLC or anything like that. And we don't actually literally, legally, as well as structurally, say that Frax, the digital USD asset, is redeemable, because it's technically not. It is stabilized by smart contract market operations. And that's very similar to how the Federal Reserve stabilizes the USD to its target CPI plus 2.5% peg. In fact, another way to think about it is inflation is just a common parlance of saying how much the dollar is off from its peg. That's the DeFi speak of the way that I like to compare it to. If inflation is 10%, for example, that means that if the dollar was a stable coin, it would be 7.5 cents off of its peg, because it's 7.5% away from that CPI plus 2.5% target, right? And so my simplistic, and Austin probably has a lot of things we can talk about after this panel, view of stablecoins is just a two-branch difference: decentralized stablecoins that are more like central banks that actually stabilize a digital token, and the traditional structured, regulated financial fiat coins that are actually give you legal rights of redeemability, but that are on blockchain rails, so that for settlement and other reasons can be disintermediated with new technology. So that's my mental picture. That's how we work at Frax. That's how we design stability mechanisms at Frax. That's how we design utility of the FXS Frax share token. And we just think about it this two type of system.
So can we understand Frax? Okay, redemption is not guaranteed, but let's say purchase power is guaranteed. So for example, if Bitcoin today is trading at $63,000, then with 63,000 Frax, we can also buy one Bitcoin.
Exactly, right? And so there's different ways in which smart contracts that are part of the Frax protocol over collateralized loans, as people are pretty familiar with, originally developed by MakerDAO, now rebranded to Sky, I think. Protocol-owned liquidity, which is something Frax actually came up with through our AMO contracts, algorithmic market operation contracts, other types of stability mechanisms that we've developed. These contracts, you can kind of think of them as algorithmic market operations, right? And you can think of them as transparent code that gets executed, that anyone can execute on a decentralized ledger. And the thing that they do is they stabilize a digital token to some purchasing power reference rate. It's exactly what the Fed does, actually. They don't give a right of redemption to dollars in 1972.
Stefan, do you have anything to add? Do you disagree or disagree?
No, I mean, I totally agree. I mean, I think there are 2 points that were brought up. I think one thing that, I mean, we're talking here about the impact of stablecoins and CBDC on the global monetary system. If you look at the global monetary system today, it's about $8 trillion in fiat terms, right? So that's the fiat terms. Stablecoins today, largely centralized stablecoins, so Tether and Circle, represent maybe 96% of all stablecoin market, all denominated in US dollars. And that is now $170 billion worth, right? So the stablecoin industry is $170 billion. And I think it's definitely having an impact on fiat money. And it's digital money. It's programmable money. And that is enabling portability with this money, fluidity associated with that. How do we now enable payments with this money? You know, Frax, you know, Sam was just talking here about buying Bitcoin with Frax coins, right? With Frax tokens. How can I now go to the 7-Eleven and buy my candy, my drink, my water, whatever I want to buy from there? That is, I think, the next path in the evolution of programmable money. If that's going to be decentralized stablecoins, it's about you and the population trusting the Frax token to be able to do that, or the merchant to trust, I want to receive Frax tokens as a payment mechanism. I want to receive central bank Sing dollars as a token, right, as a payment. Or I want to receive Nuon, a inflation-protected stablecoin, as payment, right? So those are all multiple ways, and I think we today live in multi-currency worlds. Sing dollar, I have a Singapore dollar that supports a population of 5 million people, but it's a global currency. You have Swiss francs, also supporting 7 million people. It's a global currency. And then you have the mega currency, the US dollar, which drives some 80% of global trade, all denominated in US dollars. So we all think in US dollars, and we translate that in our heads into another value. And I think we do the same in crypto. We translate, you know, Frax is going to need 63,000 Frax tokens in order to buy Bitcoin. So we're all translating all the time in different currencies. How do we do that? And what we want to do with our money is make sure it earns more money for us. So it doesn't sit idle, it doesn't get debased, and debased means the government prints more money and it depegs, as Sam calls it, so it goes away from that 2% to 7.5%. And we want to avoid that. And how does the money work for us whilst we store that, we acquire that energy by putting work into it to get money in return, and that money actually works on our behalf versus getting debased. And I think those are all things that we constantly think about in the innovation and trying to program software into money.
Thank you, Stefan. All right, moving to the next question, the unit of account neutrality. ADCV, we often discuss stablecoins' store of value aspect. Let's discuss the unit of account aspect, especially with decentralized stablecoins. A unit of account is the ultimate prolongation of an economic regime, just like language. The Great British Empire is of the past, but most of us aren't, native to English. But not only are we speaking English today, but our brains are somewhat wired to English. Fortunately, English as a language isn't really controlled by the UK. Today, we use the US dollar as our unit of account to communicate, quote, and transact. Not only our brains, but also our software systems are wired to this unit of account. But unlike any other units of account, kilometers, Fahrenheit, this unit of account is controlled by the US. Some say that the original maker or liquidity could have been the ultimate euro dollar. Some call it the crypto dollar. Crypto dollars allow us to transact in dollar norms, yet they aren't controlled by the US government. Has decentralized stablecoin technology allowed us to create more neutral units of account that are free of government intervention? Is it a mission worth pursuing? How much risk is involved for entrepreneurs that innovate down this path?
So I guess the short answer is probably no. The slightly longer answer to try and tie together something that the other panelists have talked about. My colleague Seb, he has this sort of research talk about the hierarchy of money that kind of extends Perry Merling's framework. This framework is sort of you can think of it as a sort of y-axis that starts with money at the top and then goes down into credit. And so you have, for the sake of the example, gold at the very top, then you have sort of central bank currencies underneath, then bank deposits and so forth. And in a simplified way, stablecoins sort of occupy a space at the level of bank deposits and lower. And as a category, you can maybe define it a little bit more precisely as a sort of a private liability issued on chain that promises to maintain a stable value relative to a reference asset. And I think just to pick up on like the crypto dollar term, personally I like the term, the way that sort of Seb frames it, and I think Nick Carter coined it in a very similar context, where a crypto dollar is a stable coin, but that also offers on-demand redemption for higher money, so for higher levels of money. And in this framework, I think it's much easier to see that decentralized stablecoins. So, for example, within just crypto dollars, you have full reserve crypto dollars like USDC or PyUSD because they're redeemable for T-bills and bank deposits. And you can also have fractional reserve crypto dollars, similar to USDS, formerly DAI, or USDT, because they have access to that sort of higher level money, but they also have investments in less liquid assets. And by fractional reserve, it means the composition of the assets, not the absence of assets, like Terra. And so decentralized stablecoins, they don't offer that redemption path to higher level money. So they're more like sort of credit, right? I guess the original mission of something like Liquidity is probably to do something like, oh, we want to offer something with no government intervention possible.
Because that higher money, if it's T-bills.
Right, but I think the point is that it has a place in the same vertical hierarchy. Even Liquidity is not free of government intervention. It has to inherit the monetary policy of the Fed. And if it wants to maintain its promise, it has to obey the lizard people in the government. And so I think if we really want to, I think there's a good case for having a neutral reference asset. I personally believe it. Like it's a way, like if we want to aspire to a mission of breaking away from central banks, and I personally, deep down secretly really hope that we do one day, I can't think of a truly you would have to start with a truly neutral reference asset at the top. And this would be something like Bitcoin or Ethereum, frankly. And in order for this to function fluidly, you would probably need some kind of a similar hierarchy within Bitcoin and Ethereum. And you have emerging mechanisms like Lido staked ETH is a sort of in the same way they have crypto dollars, Lido staked ETH is a sort of crypto ether, right? And then you have like more varieties of like credit on Ethereum and so forth. But if you're a dollar, unfortunately, I think you are not free of the lizards.
Got it. Sam, yes?
Yeah, so just to add there, I actually totally agree with pretty much everything there because my view, regardless of whether it's decentralized stablecoins or redeemable ones, if you're pegged to USD at sufficiently large size, you cannot escape the actual reach or the long arm of the US government. My spicy take is there's no such thing as Eurodollars. Structurally there is, right? Like different reserve bank requirements and stuff, but like it's all under the umbrella of the United States government, the Treasury, and the Federal Reserve System, right? I mean, if you're using this peg, this was my personal always thing that I was confused about, like Liquidity, which I love, but the extreme decentralization is the wrong end of it because the peg is dollars, and then the entire system is very decentralized, more decentralized than Frax. There's no MSIGs, there's nothing in Liquidity. And in fact, I think Stefan agrees with me here, is that we think the evolution of being a sovereign unit is you have to actually figure out what the dollar actually does for people, not like the fact that, oh, you can pay your taxes or things like that. It's actually pegged or attempts to be pegged to a standard of living, right? The CPI plus 2.5% target. And so our view, and Frax actually, its third asset that it issues after Frax Ether and Frax USD stablecoin is the Frax price index, which is similar to Nuon, and that we're the first flat coins, which is basically saying that the reason the dollar is valuable is that it tries to keep some standard of living so that people can do their actual accounting, their debt that they have against their homes, their jobs, their credit, and all this stuff. And that unit is very valuable, that unit of account usage. And even though it's very hard to displace that, as you said, it's almost like a lingua franca of economics. If there is going to be some other, successor to like a nation state unit, like something after USD, it has to be a thing that's actually tracking some standard of living, but actually has collateral like Ethereum and Bitcoin and these fully decentralized things. So you can't have bank account deposits, because again, then you entirely depend on the long arm of the U.S. and international financial system. So it's actually a two-step process. And so for people that are familiar with flat coins, I think it's a idea that's very, very early, but they're the final, maybe in 5 years and in 10 years, they're kind of the final holy grail of stablecoin research and design. And I think two probably out of all of the two in the world issuers of flat coins are on the stage, right. Frax and Nuon. And the idea behind it is that you need to actually keep some definition of peg or standard of living and then build a decentralized, completely independent financial system on top of that.
Great, thank you. So Stefan, we'd like for you to share your experience there with flat coins. I think as soon as you break away from the dollar, it's kind of like creating a new language, right? Which is always hard because habits die hard. So what was your experience there?
So we're working on V2 of the flat coin, and I think to CV's point was we really are keen to have an alternative backing that supports that. And what is the alternative backing, right? We know what are anti-inflationary assets. Those are gold, that's oil. We all need energy. We need to survive on energy. It could be uranium in the future, but still today oil drives most of the electricity that we get everywhere to access the internet and all the services that we use. You also have gold has been an inherent asset, but we also have Bitcoin emerging into that marketplace, and you have other assets. So how do you build out an asset base that acts as the backstop that people can redeem against and hold the cost of living and provide a yield to the holders of your flat coin? And I think
how do you push for that new habit, that new thinking, that new unit of account?
So we tried to do that in two ways. The first way we tried to do that was just have an appreciation of value in a coin that would be dollar plus inflation. People couldn't grasp that. It was too early. The market did not digest it. And so in version 2, we've decided to do the rebasing strategy. So you earn yield because people understand yield-bearing stablecoins. They understand interest on, you have to come up with a different name because I think a lot of security lawyers are not going to like the fact that you're paying out yield. But we'll come up with some, we call it rebasing, right? So we don't call it yield. We call because you get debased. Your dollar gets debased when they print more money. So inflation provides a debasement of your position in the market because there's more dollar out for the same goods that are in circulation. Yeah,
but
so
that's not really a unit of account. Like for me, I'm used to kilometers, right? So when I go to the U.S. and I see miles everywhere, I can't think.
Yeah.
So how do you push for that new habit for people to adopt it?
You're already seeing accounting change, right? Downturns in economies are fantastic. We hate them, and it means we have to push hard. It makes us and entrepreneurs in this space do hard things, right? And it forces us to be creative, imaginative, and innovative, right? And so what do? You're seeing today medium businesses start to track the performance of their stocks based on sats. So how many sats per share do you have outstanding? And so they look at people's balance sheets. So Michael Saylor with MicroStrategy, you have elements like that. But you have small gyms that are publicly listed that now are accepting payments. You have all convenience stores that are accepting crypto as payments. And so they have a balance sheet. Those payments are in crypto assets. And so I can break them down and translate them into sats, satoshis. That's the cents equivalent of Bitcoin for those that might not know in the audience. And now all of a sudden I can contrast that to a new metric, and it becomes a new metric. It's not anymore price, PE earnings, and it's all of a sudden sats per share. And in crypto, we have to come up with a new metric. And I think Sam's really trying to push hard to drive innovation in what is the new metric that we need to define for crypto so that we actually appreciate the communities that are helping build the value of these tokens, the participation that you have with a token in the underlying governance and the security of a protocol, et cetera, et cetera. And we don't have a term for that, and we need to build that. We're only 10 years old, guys. I mean, we're not fiat-based dollar. How old's the dollar? what, 100 years, 200 years old?
200,
200.
200 something.
Yeah, 200, right? And it was a consolidation of all different currencies across the whole U.S., right? I mean, every state had its own currency. So, yeah, we're not that mature yet. And so we still have some way to go. Sorry, Austin.
No, that's fine. One thing I kind of think about / worry about, and so I was on Alex Thorne's podcast. He's a friend. He's over at Galaxy Digital and sort of self-admitted to being a grouchy fixed income person, is that crypto is sort of speed running some of the lessons of finance. And one of the things that I try to caution people with is when you change the definition of money, you are going to have a lot of people who start pushing back pretty hard on things, both for intellectual reasons and also structural reasons. And one of the things I really worry about as somebody who studied a lot of the history of financial crises is what I will call an overemphasis on inflation in the crypto space, because that's what we've been facing recently. But as a general word of caution for builders, users, et cetera, in this space, if you think inflation is bad, try deflation. Where if you look at the greatest downturns that we've had in recent financial history, it's actually deflation, not inflation, like say 1929 and the crisis that followed after that. So one thing that I would sort of point out here is if we want to talk about flat coins and inflating coins, those work well when money supply is increasing relative to money demand. But I just said something that's very important, which is money demand. We're very good in this world at measuring money supply. We're actually absolute flaming garbage at measuring money demand. Like nobody in anywhere in economics has a really good metric for money demand. But when that falls and you have deflation, all of your flat coins will have to start going down, and that will drive people crazy. So we have to be very careful with the definitions.
Thank you, Austin.
Just on that, I'm curious, sort of out, we spend a lot of time in inflation, right? I mean, we're in the economic space, that's what we do. But one of the things that we've found is that there are two types of inflation. There's the consumer price inflation, and then there's this asset price inflation that is very different to consumer price inflation. How do you view that? And how do we sort of play with those elements in an inflationary world? What's more important?
I mean, so the answer to that question is a somewhat complicated question on what do people think standards of living and value are. The answer is when times are good, they care about asset price inflation. When times are bad, they care about consumer price inflation, which is kind of related to my inflation deflation type argument. And the answer is, and part of why I think it's hard to push people to those definitions is there's not a stable point of definition. It's a little bit like turbulence in airlines, right? Like things are smooth for a very long time and then something happens and suddenly things are not very smooth. And we're good at understanding when things are smooth and we're good at understanding when there's turbulence. What we're not good at is understanding what shifts us between those two states.
Yeah.
All right.
I just wanted to add super quick that exactly as Austin was saying, inflation is basically the thing that links investment assets between currency, because currency is supposed to be stable to a standard of living. And investment, if you think about it, if it's a good investment, it should increase your standard of living, right? Because you can sell it for currency and do the things that you want. And the issue is if you have deflation, your currency essentially becomes an investment asset, which is just a different way of saying that holding pieces of paper of dead presidents is society allocating like valuable resources to people who hold these pieces of paper, right? Because its purchasing power is increasing over and over. And I totally agree, that's a very bad thing.
All right. Third question. Stablecoins power infrastructure. In November 2021, the U.S. President's Special Working Group on Financial Markets, co-led by the Treasury, FDIC, and OCC, released a stablecoin report which provided the first solid outline of a preferred stablecoin regulatory framework. It outlined that centralized stablecoins aren't just tokenized money market funds, because unlike MMFs, people perceive and use stablecoins mainly as payment instruments. And therefore, availability is critical. It means that stablecoin networks should have near zero downtime. But ADCV, our industry rarely discusses the inherent risk of the stablecoin availability mismatch, especially with centralized stablecoins. Crypto users expect and are used to 24/7 redemptions. Whereas most TradFi payment instruments such as credit cards, PayPal, and Grab Wallet do have near zero downtimes, the financial institutions that help centralized stablecoin issuers hold and liquidate reserves do not. They actually have plenty of downtime. Most are closed all weekends. That's okay because they usually serve investment and not payment purposes. History has proved that centralized stablecoins have higher depegging risk during weekends, like the last big depeg. How can we solve this inherent availability mismatch issue?
So by availability, so here's an interesting thought. I think this redemption window is relevant only to the extent that there is a separation between two settlement layers, one on blockchains and one on fiat rails. To be honest, like for most intents and purposes, stablecoins are used as payment and circulate quite freely. So the need for a redemption for higher value bank deposits, let's say, over a weekend is in most instances fine. And it's not fine when there's like a clog or a rush to the exit because users decide that they stop wanting to use the crypto settlement layer. But this distinction is somewhat artificial, and it's kind of enforced. So if you try and take an expansive view and put stablecoins inside the hierarchy of money, it shouldn't really matter whether it's a bank deposit on fiat rails and crypto rails. They're just two databases that are recording a transaction, and all of the friction happens at that little bridge. And that little bridge only really exists because of a sort of mutual incompatibility between the two layers. And on the other hand, also because of regulatory panic, maybe, or anxiety about mixing the two layers for some reason. And so I actually think that there's one way of solving this, and this is something that we're sort of, at Steakhouse we like to advocate for, is singleness of money within stablecoins. I think would actually do a lot for solving the choke point in crossing the two rails. In an ideal world, we wouldn't make the distinction between either one, and if you wanted to change settlement, you would just transfer stablecoins or redeem them somewhere else. At the moment, we have a system where stablecoins privately issued crypto dollars don't recognize each other's liabilities, right? In most instances, there is a competitive angle to this. In my opinion, this is largely because of the immaturity of the industry at the moment. So there's a sort of like a mid-curve approach, almost of like, everyone should use my stablecoin and nobody else's. Yep. It would be much more efficient if Circle held Paxos dollars and vice versa, so that they could settle with each other on chain. Then you wouldn't need a redemption window at all into fiat, right? And for what it's worth, like this singleness of money that as it exists in TradFi, this is what people are used to because it's completely abstracted from them. So when a Bank of America dollar user sends a fiat payment to a Chase dollar user, neither party understands what's happening in the back end. For them, there is a singleness of dollar across privately issued liabilities. So I think and on the regulatory front, there's for what it's worth, singleness of money doesn't actually need CBDCs or central banks to enforce. Right. Yes. All it takes is private parties that recognize each other's rules to accept that and accept each other's liabilities. And then that's fine. And this has worked in history in the past. Like central banks are actually quite a recent innovation, if, for what it's worth. And, banks existed and settled each other's liabilities previously, and everything seemed to work fine. And so I think one way of solving this sort of redemption window availability crisis is by allowing that. And in some aspects of regulation could be helpful, but to take the example of MiCA, for example, in Europe, it explicitly prohibits stablecoin issuers from holding each other's liabilities as reserves. So this is a situation where you have like government intervention making things worse, right, and riskier relative to if they just allowed Monerium to hold EuroC, for example.
I really like that apply, and also the U.S. Treasury made the same point in their report that interoperability is something that they really want.
But because they're like concerned about risks to monetary policy transmission and systemic risks to the incumbent financial institutions.
Right.
And this is illustrative of the private-public partnership that the incumbent financial services industry has with the government. To all intents and purposes, a lot of it is already effectively nationalized. And I think that's a real shame for innovation, and I think it would be better if it were more competitive in this regard.
I would also go so far as to say I don't think the government even understands the current system before we get to stablecoins, because as a little note on that President Working Group memo, when somebody sent that out, I may have texted one of the authors angrily a picture of my Fidelity debit card, which if any of you live in the US understand, that is a government money market fund that you could spend as money through the traditional rails. So what they said to start that memo, strictly wrong, just to be clear, like factually incorrect.
Yeah, and thank you, Austin. We're out of time. I just wanted to end by saying that I remember in Professor Merlin's class, he talked about the 4 prices of money. One price of money is the interest rate. Another one is the cost of par, because back in the day in US history, for us to create that par between different bank deposit, it was not easy and it was very costly. And as we all say, crypto in stablecoins, we're still early, so that peg is going to still cost us some time to build up. So with that, thank you. I'd like to really thank the panelists. Thank you for having us.
Thank you.
Thank you.
Expecting that panel to go into a full-on discussion of non-USD stablecoins as an issuer of flat coins on Solana. Very much a fan of having stablecoins that are decoupled from the traditional finance system. Big thank you to Wayne. That was a excellently, expertly moderated panel. Actually, the one point that you made that I like the most is that the US dollar truly is the lingua franca of the financial system, and it is controlled by the US government, unlike other standards of measurement. Also, I thought it was pretty interesting that we had a discussion about the different types of inflation, whether it be about asset price inflation or CPI price inflation. At what points in time do customers care about asset price inflation versus CPI is also a very interesting topic. It's also bad. One thing that I had a hard time wrapping my mind around is how exactly it's bad to pass on value from society to currency holders, but I guess that's a conversation for a later date.